established by the law, which is your statutory tax rate. Now, the effective tax rate can be different. Why? So, think of the permanent differences that we talked about. What are the things that could lead to permanent differences between your accounting profit and your taxable income, such as, for example, interest income from municipal bonds? Now, as I already told you in the previous video, that municipal bonds are semi-government issued bonds, so they're from semi-government organizations, municipalities, and they are exempt from tax. The income that you get from them, the interest income you get from them, is exempt from tax, which means your accounting profit will be higher, right? Because that is going to show this income, right? But your taxable income will be lower because it's not going to include this income since it's tax exempt, right? And therefore, this will be a permanent difference. And since you will have to pay a lower tax because that income is not included in your taxable income, your effective tax rate will be lower than your statutory tax rate. So because of these permanent differences, and there are a lot of other examples that we talked about with respect to how you can get permanent differences between accounting profit and taxable income, but it's these permanent differences that make the statutory tax rate different than the effective tax rate, right? It's not always lower. The effective tax rate can be higher as well. For example, let's say we take the example of fines, right? So let's say as a company, you have had to pay some fines, and those fines will be reducing your accounting profit, but they will not be reducing your taxable income because the tax authority is not going to allow them as expenses, right? They're not going to allow them as tax deductible expenses. So that will be a permanent difference as well, which means the tax you will have to pay will be higher than what is the tax rate established by the law. So your effective tax rate can be more than the statutory or less than the statutory, depending on what is the reason for that permanent difference. Is it some revenue that you are taking and the tax authorities are not taking, or is it some expense which you are taking and the tax authorities are not taking? Example, fines, right? And an example of the revenue was interest income from municipal bonds. Now, coming to cash rate, this is that temporary difference that we talked about, which leads to deferred tax asset and deferred tax liability, right? For example, maybe there is a difference in your depreciation expense, which you are taking in the accounting profit, versus the depreciation expense which you are taking in your taxable income, right? So eventually that is going to get sorted out, because if let's say the asset is worth 100 million and you are depreciating it 10 million this year, whereas your taxable income is being calculated by depreciating it 40 million this year. So naturally the expense is different this year and the carrying value and the tax base will be different for now, but at the end of the day, or at the end of the, you know what I mean, like at the end of the entire life of this asset, the entire thing is going to be depreciated out, most likely. So after the life of the asset is done, the total depreciation will be the same for both. So this is just a temporary difference, but it does result in a different amount of tax being paid for the time being, and therefore the cash tax rate, which is the tax actually paid divided by the income, will be different, right? And Why is this important for us as an analyst to check the effective tax rate versus the cash tax rate? Because as you know, valuation, which you will learn in CFA level 2 in more detail, is based on cash flows, right? So it's very important for us to forecast your cash flows. So therefore, when we're doing cash flow forecasts, and we need to take into account what is the tax actually that's going to be paid, right? The actual paid amount of tax, then we will do that based on the cash tax rate. So as discussed, differences between cash taxes and report taxes occur due to the temporary differences, the timing differences between your accounting and tax calculations. And these are the ones that give rise to deferred tax asset or deferred tax liability, which we have already discussed in detail. Right, as far as the difference between the statutory rate and the effective rate is because of permanent differences, right? And of course, tax credit is also something that leads to permanent difference because it will reduce your taxable income, but it will not reduce your accounting profit, right? Any kind of adjustments from previous years or withholding tax on dividends, etc., will also have a reason to impact the difference in your statutory tax rate and your effective tax rate. But the main thing over here is that permanent differences are the ones that lead to your effective tax rate being different than from your statutory tax rate. Now, for a multinational corporation, you have to look at the weighted average because it's going to be paying tax in multiple countries, right? Some countries, let's say USA and France. So let's say the tax is 40% in US, and just giving you an example, and 30% in France. So if they have 50% of their revenue coming from the US and 50% from France, then we'll just take an average of 40 and 30, right? But if that is not the case, it is not 50-50. Let's say 80% of the revenue is coming from USA and 20% of the revenue is coming from France, then what we will do is we will give 80% weight to the US tax rate and 20% weight to the French tax rate. So this is the whole concept of a weighted average, right? And definitely, if a company is having a higher profit, or rather, instead of revenue, I should say profit. So this is not revenue, this is profits, because tax obviously is applied to profits and not revenues. So if this company has higher profits in the country which has the higher tax rate, naturally its effective tax rate will go up because it will be pulled more towards the higher one, right? Because of the higher weight. And again, why is this important for us as analysts? Because if we're going to be forecasting earnings, we'll be using the effective tax rate. Whereas if you are going to be forecasting cash flows, then you will be using the cash tax rate. If there are one-time events, let's say there was a payment of a fine, that was a one-time fine, which is why the effective tax rate was different than the statutory tax rate. But that was a one-time thing and it's not going to happen again. So as an analyst, we shouldn't take that effective tax rate, which was higher because of that one-time fine, but we should adjust for that or remove that before we make our forecasts, right? And how do you know it was a fine or it was something that is non-recurring? Is this recurring or non-recurring? How do you know? How can you check, right? Where can you get into the details of this? That is going to be in the notes in the financial statements, right? But if you feel that a company is reporting an effective tax rate which is consistently lower than its statutory or higher, right, consistently different, then you really need to get into the details and scrutinize the notes, because why is this happening? If it was a fine, then that should have been a one-time thing, right? But and anyways, that would make the effective tax rate higher. But if let's say it's something like interest income, right, interest income from municipal bonds. And that means consistently they're not having to pay tax on that income, which would make their effective tax rate lower than statutory rates. And before you can forecast and do your projections, just scrutinize and make sure that it is something which will continue to be tax exempt, and therefore it will be consistently making their effective tax rate lower than their statutory rate, because it has to be scrutinized. Otherwise, it doesn't make sense that how can the effective tax rate be consistently lower than the statutory rate or from the effective tax rate reported by competitors. There has to be an explanation, and that is why we as analysts must scrutinize this. Right. Now, coming to the presentation and disclosure. See, the important thing over here to understand is that whether you're reporting a deferred tax asset or a deferred tax liability, there should be a high probability of them being reversed. So if you paid extra tax and then you're hoping to pay less in the future, then you can show a deferred tax asset. But then you have to be a going concern. You have to be a company which is expecting to declare profits in the future and not have to pay tax on it. Only then your deferred tax asset will be reversed, right? But if that is not the case, then you need to reduce this. And in IFRS, it can just be reduced. And in US GAAP, we reduce it with a valuation allowance. But this is the high level concept over here, that if you are showing a deferred tax asset or a deferred tax liability, it is expected to be reversed in the future, right? If you feel that it will not be reversed, then you have to reduce it, right? And if we are talking about a deferred tax liability, right? If you're going to remove this, then to keep your equation balanced, your accounting equation, which is assets is equal to liabilities plus equity, and if you're removing something from equity, you need, if you're removing something from your liability side, you need to add it to your equity side. So if this gets removed here, it will get added to your equity. And when you had booked that liability, obviously you had booked an expense, the tax expense, but you hadn't paid that cash, right? So you had let's say you had an income tax expense of 10 million, right, in a given year, but the income tax paid, the tax paid was only 4 million. So what you did was the remaining you recorded as deferred tax liability. Now, if you are getting rid of that deferred tax liability, initially that expense had reduced your equity, but now you will increase it back if you feel that this will not be reversed. In the case of uncertainty, whether you as an analyst are not sure whether it will be reversed, it will not be reversed, so then you should neither treat it as a liability or equity. You should just remove it. Now, with respect to deferred tax asset, let's say you paid extra, right? As per your tax expense, you thought you should have paid 10, but actually the tax paid is more. Let's say the government took from you 16, right? So you paid 6 extra. So what you are assuming is that maybe the government has taken some, let's say, unearned revenue as revenue, and later on you will be declaring it as revenue and the government will not, and you will be able to reverse this and not have to pay tax in the future, which means this asset will give you benefit in the future. But then you're assuming that next year you will be able to deliver on those goods and services and convert that unearned revenue into revenue, right? But what if you're not able to, right? What if you are not able to deliver? Then this DTA will never be realized, and therefore you should get rid of this on your books. In the case of IFRS, you can just cancel it, right? But in the case of US GAAP, you have to show a contra asset account, which is called a valuation allowance, right? And that is how it's done. So a DTA can be reduced using a valuation allowance under US GAAP. And when you book a valuation allowance, it's very similar to depreciation in that manner, that if, let's say, we have a property, plant and equipment asset and of 100 million, and we're booking an accumulated depreciation, right? We're showing an accumulated depreciation of, let's say, 10 million, and the carrying value is 90. So this is also a contra asset account. So similarly, a valuation allowance is also a contra asset account. And every time you book depreciation, it's an expense, right? It reduces your profit. Similarly, whenever you have a valuation allowance going up, that also reduces your income, right? And if you revalue it upward, then that means you're decreasing the valuation allowance. So you're kind of going in the opposite direction, where you will be increasing your earnings. So again, it's very similar to depreciation. So you can think of it in terms of depreciation, that when the expense is there, income is down, right? So similarly, when valuation allowance goes up, income is down, and it is shown as an expense. So depreciation is shown as an expense. However, valuation allowance is shown as a loss on the income statement. Right. Very interesting. What happens if there are changes in the tax rate in the future? Now, remember that we were calculating the difference by taking the difference of the carrying value and the tax base, right? To calculate what was the difference in the expense that the government had booked versus the expense that we had booked, right? And let me bring you back to that example. So let's say our carrying value is 25, the government's tax base is 10, so clearly there is a difference of 15, and that's because the government had booked a depreciation of 40 and we had booked a depreciation of 25, and that's why there's a difference in the depreciation amount. Hence, that same difference is showing up in the value of the asset on our books versus the value of the asset on the books maintained by the government for our company. Now, this amount is obviously multiplied with the tax rate to find out what will the tax implication be, and that is what will help us calculate what will be the deferred tax asset or deferred tax liability. But the point is that if there is a change in this tax rate going forward, right? So if the tax rate goes up, let's say if the tax rate goes up, whether we have recorded a deferred tax asset or deferred tax liability, either of them will be going up, right? So that is the important thing to understand, that if your tax rate goes up, so let's say it is, okay, let's take this example where it's actually going down. So it's decreased from 40 to 30. So earlier we had taken 40 and we had calculated a DTL of 6, right? But if it goes down, then this will go down. And it's not just because it's a liability. Even if it was an asset, if it was the other way around, where we had recorded a deferred tax asset for some reason, then if the tax rate had gone down, then the DTA would have gone down as well. So the relationship between tax rate and DTA is such that if tax rate reduces, both of these will be going down, whereas if tax rate goes up, both of these will be going up, because the basis for calculating the DTA or DTL is the tax rate. Okay, so let's have a look at this example. A firm has net deferred tax liability. The government announces a decrease in the rate, so the rate is going down. Obviously, your tax liability will be going down. Now, what will be the change on the income statement and the balance sheet? If your tax liability is going down, that means there will be a positive impact on your income statement, and your liability will be going down on your balance sheet, right? So expense will go down. That's obviously good for your income, because your income will go up, and your liability will go down, right, on the balance sheet, and it will get transferred to equity. So equity will go up. So that's a good situation to be in if you have a net tax liability and the tax rate is going down. However, if you have a net tax asset, so let's have a look at this situation. Do they have a deferred, so they have a deferred tax liability of 70 and net deferred tax asset of 5. So this is tricky, right? Because they have a deferred tax asset of 75. They have a deferred tax liability of 70, but asset is more than liability. So here, because there is a net deferred tax asset, if this tax rate were to go down, let's say this goes down to 35, then this company would not be happy, because their asset will go down, and if their asset will go down, then naturally, so what is the impact of the tax rate going to 35? Well, obviously the net DTA will go down, which means they will book an expense, right? If it's through US GAAP, it's US based, so they will be booking a valuation allowance, right? So it's not going to be an expense; it's going to be a loss. So valuation allowance is going to go up, and a loss will be there on an income statement, and your equity will be going down. Right. Let's have a look at the first 2 points as well. So the first one is, what does a decrease in valuation allowance imply? Well, a decrease in valuation allowance is a good thing, because that probably means that the company is going to be making more money in the future, right? And they will be able to realize their tax asset. Let me explain this again, by the way. So sometimes what happens is that we record a deferred tax asset, which means we've paid more tax. We've like prepaid our tax, right? We've prepaid tax, and therefore we record this asset. And we're hoping that in subsequent periods we'll be able to generate so much profit that we would, as per our income tax reporting, as per our tax expense, based on the financial reports, we will be having a tax expense, but the government is not going to ask for that payment, because they've already taken the prepayment from us. So we will be able to realize that deferred tax asset. But for some reason, let's say we feel that we will not be able to report higher profitability, and we had reduced that deferred tax asset by recording a valuation allowance. Now, if that valuation allowance is being decreased, that could only be because the company expects higher profitability in the future, which is obviously good, right? How does a reduction in valuation allowance impact your income statement? Well, first of all, it's going to reverse that loss, right? So you will have your income, which is going to be higher. And finally, if it goes down to 35, your tax rate, unfortunately for this company, because they have a deferred tax asset net of deferred tax liability, therefore they will be sad, because their asset will go down, the value of their asset will go down when the statutory tax rate goes down, which means their equity will have to be reduced as well to keep the accounting equation balanced. Right. So if you have completely gotten rid of your deferred tax asset, that is, you've booked a valuation allowance which is equal to your tax asset, you're basically saying that I'm not going to be able to realize any of that before it expires, right? And if a company is decreasing or reversing the valuation allowance which they had earlier booked, this means that they are expecting that the company is going to be profitable and it will be able to realize that deferred tax asset. Okay, so that is it for this learning module. Let's have a look at the summary. We talked about accounting profit and how it is different from taxable income, and the taxes that we pay are linked to the taxable income, whereas the income tax expense that is shown on our financial statements is obviously linked to the accounting profit. And you can memorize this equation if you want, right? Or you can write it down on a special piece of paper that where you write down all your things to memorize and just review it before the exam date. However, what I would suggest is intuitively trying to understand what's going on over here. So first of all, this is just net change in DTL, where you take your change in DTL and minus your change in DTA, right? And if DTL is going up, that means that you're paying less now, you have to pay more in future. So let's say if you thought you had to pay 10, but you've paid less now, and clearly you are going to have to pay more in future. And this is the basic relationship, that income tax expense is equal to income tax payable plus net change in DTL. You can remember the equation, or you can just try to intuitively solve the question when you get it. So next thing is permanent differences will lead to your effective tax rate being different than your statutory tax rate. So for example, if you've got interest income coming in from municipal bonds, your effective tax rate will be low. Or if you're paying fines, then your effective tax rate will be higher than your statutory tax rate. And your formula for reported effective tax rate, so effective tax rate is equal to what is shown on your books, your financial reporting books. So you take your income tax expense, right, and you divide it by your pre-tax income from your financial reporting books. Right. And we also talked about this very nice chart. So on the asset side, if your carrying amount is greater than your tax base, let's take the example of PPE, right? That you're depreciating less and the tax rate is depreciating more. Let's say you have 100 minus 10, whereas they have 100 minus 40. Naturally, the tax you will be paying today is less, but tomorrow you will have to pay more on it. I mean, it's good for cash flow, but eventually, of course, the amount of tax will be equal. So this is a temporary difference, but definitely good for cash. On the other side, let's say you have a research cost that you completely expensed in the first year, right? Compared to dividing it across 5 years. So then you can have a deferred tax asset as well, because you have paid extra and then you will be able to recover it as you book this expense of 20 each year over the next 5 years, right? In terms of your liability, let's talk about unearned revenue, right? Maybe you've got some money from your customer, you haven't realized that revenue yet because you haven't delivered the goods or services, but the tax base has, the tax authority has recognized that revenue and not showing that liability. So clearly the carrying amount of the liability on your books is greater than the government, which means the government will have taken extra or advance tax from you, right? You've prepaid the tax and therefore it's an asset for you, because next year when you show this revenue in your financial reporting statements, and the government will not be showing that revenue since they've already shown it in the previous one, so the tax you have to pay will be less than what you will be calculating for that year, and you will be able to realize your DTA. And if the carrying amount is less than the deferred than the tax base for a liability, then what you have is a DTL. Right. And DTLs are created when tax paid is less than your financial reporting tax expense, right? And this could happen because of unearned revenue and credit sales. So account receivable, for example, if you have revenues that are showing in your income statement, but the government is not recognizing those revenues because no cash has been received for them, right? Or there are some expenses which are recognized on the income statement but not recognized on the government's record, such as bad debts, right? So this could lead to a DTL. DTA could be where you're paying tax in advance, right? This could be maybe because of unearned revenue, right? Because the government is taking that revenue and making you pay tax on it, but you haven't taken it in your books yet. So you can record a DTA for that. Or when expenses are recognized in the income statement before they are tax deductible, and that also is the bad debt example that I gave you. All right, and we also talked about the differences between statutory tax rate, effective tax rate, and cash tax rate. So these two happen because of your permanent differences, right? Which could make your effective tax rate lower or higher. And the cash tax rate difference with effective tax rate happens because of your temporary differences. Yeah, so that's your timing differences. And they give a rise to deferred tax asset or deferred tax liability. And finally, as long as they are expected to reverse, you can show deferred tax asset and deferred tax liability on your books. If they are not expected to reverse, DTL will be converted into equity, right? And DTA going down is bad because it's going to cause a loss for you. They can also go down if your tax rate goes down, right? So both DTL and DTA can go down if your tax rate goes down, whereas if your tax rate goes up, both your DTL and your DTA can go up.